Hello and welcome back to the FT Markets Bubble series. Today we're going to be talking about emerging market carry trade, which involves people taking money out of the developed world and chasing higher interest rates in emerging markets. To discuss this and whether it's become excessive yet, I've got David Bloom, Head of Foreign Exchange Strategy at HSBC. David, to start with, we'll just bring up a chart here which shows quite nicely how this has worked. Just talk me through what's going on here in terms of the carry trade this year. How do people make money from this?
Well, the whole idea is you borrow money very cheaply and you just deposit it in another country that has very high short rates. Now, if everyone follows you and everybody does it, then the currency goes up, so you make a capital gain, and you earn a high yield. So it's a double whammy. It's delicious. It's irresistible.
Yeah.
You see at the top there, Brazil, for example, where you get the double whammy. You get a higher interest rate. So let's say you borrow money in sterling at very low rates. The US, you spoiled for choice, the Eurozone, Japan, Switzerland. You put your money in Brazil and you earn a much higher yield. But at the same time, the currency.
So this is the gain in the currency, and this is the total, including the gain in the currency and the extra interest that you would have got.
Double whammy. You can't. Okay. It becomes irresistible when that happens, and especially when volatility is very low. And I think you've got an example there of Argentina, which shows you a massive capital loss.
Yeah. So the blue is the capital loss, but you would just have eked out a tiny return when you include interest.
Yes, because at the end of the day, they're paying you for risk. They're not paying you because they like you or think you're a nice person.
Yeah.
What you're getting paid for is risk. So the question is, are you getting paid excessively? And in this case, you'd say, oh, Brazil, yes, they are. So you get very much attracted to it. And that's the lure. That's the attraction of carry with where am I going to get money from? How am I going to earn money? Well, let's borrow money in a low yielding currency, put it in a high yielding currency, and we could win twice. And when you do, you got Brazil. And that's you don't get better than that in financial markets. However, as you're going to say.
Yeah, so let's have a look at how this has actually worked if we bring up the next chart. So this is what you would have made if you'd simply bought the three highest yielding currencies and funded that by borrowing in the three lowest. So it was a screamingly good trade during the years up to the crisis, but unbelievably bad during the crisis. Now, is this really just a way of, I mean, this is the classic picking up pennies in front of the steamroller, and when you get run over, you really get run over.
Yeah, well, usually it's slower, and you can see from 08 upwards, you're slowly picking up those pennies. You feel comfortable, the steamroller, but you slip over, and the drawdowns, as we call them, are vicious. And if you get caught in a drawdown, you get absolutely slammed. So this is the problem with it. No free money in the markets is nothing without risk. And these emerging markets, the drawdowns are vicious. And the question is today, are we at a peak level and will we see a big drawdown from here?
Well, exactly. We had this big drawdown last year after the taper started. We've had a dramatic recovery this year. Is this all just too good to be true? The final excitement before the Fed raises rates, before everything comes to an end and the carry trade blows up?
Well, the point is volatility is so low. And if there's no volatility, and even if currencies do not give you a capital gain, you're getting paid for yield. And many people are turning to emerging markets in maybe an act of desperation and trying to get yield. But you're absolutely right. The danger point is coming. The Fed are talking about raising rates. The market's talking about a Fed rate hike. We are quite cautious on carry at the moment because of this. And if the long end of the US curve picks up, saying that the Fed's behind the curve.
So you mean if the 10-year Treasury bond yield starts to rise?
Yeah, that's correct. So if we start getting a fear that actually the Fed is behind the curve, inflation's taking off, they're going to have to raise rates a lot more, then carry really gets smashed. And you can see in that drawdown last year, that's when 10-year bonds went from roughly 2.5 to 3.5 within a month. Yeah. And that just killed all the carry trades. So I'm a bit cautious now, but you can understand the lure, the attraction. With zero rates around the world. You can pick up roughly 10% rates in some of these other countries, but it doesn't come without its risks. If you slip in front of that steamroller, you get squashed.
Yeah. So thank you, David. Well, there we have it. The carry trade might be for you if you think the US economy is going to remain weak and that the Fed will keep rates low and volatility low for the foreseeable future. If you're worried about the US and you think that the world's going to recover, perhaps that steamroller is just a little too close for comfort.